On Thursday last week, we talked about identifying trends, and I'm sure we all remember everything we discussed in that session, because whatever we talked about previously, I always try as much as possible to do a follow-up on the topic to be able to complete the whole idea towards that topic, and that's why we're having a trend reversals class today. Okay, so I send out polls regularly. Please let's respond to the poll. Thank you. And let's dive right into what we have today: the Smart Trader's Guide to Trend Reversals. Okay, the Smart Trader's Guide to Trend Reversals. And in today's webinar, we'll go through introduction. What are trends and trend reversal? How does a trend reversal occur? Spotting a trend reversal, key takeaways, and a conclusion into what we'll be discussing today. So, before I begin, can anyone tell me what a trend is? Then what a trend reversal is, okay? Let's talk about what a trend is first. Then what a trend reversal is. What is a trend? Then what is a trend reversal? Anyone at all? Can anyone tell me what a trend is, then what a trend reversal is? Okay, I'll give us 2 minutes to do that. Anybody at all? Can anyone tell me what a trend is and what a trend reversal is? Anyone at all? A trend, then what a trend reversal is? Okay, can see a lot of people typing, so I guess I still had more minutes to that. Okay, still waiting for okay, so a lot of people said the general direction of price, direction of markets. Okay, then reversal is the trade movement, is the movement of trade of price to a particular direction. Yeah, that's trend. That's trend. But I want someone to tell me what a trend reversal is. Okay, what a trend reversal is. What is a trend reversal? Is a reversal is a shift or change in price to a different direction from previous trend. Brilliant. Brilliant. Very, very brilliant. Okay, so from my own perspective about trends and reversals, okay, a trend is the general direction in which market value or the price of an asset evolve. Okay, trends can be upward, downward, or sideways, which is bullish, bearish, or flat. There is no specific timeline for a direction to be considered a trend. Okay, but overall, the longer the direction is sustained, the more qualified the trend becomes. Okay, the longer that direction is sustained, the more qualified the trend becomes. So basically, the trend is just the direction current price is going to. The direction price is going to currently. That's what a trend is. It's not difficult at all. It's no brainer at all. It's just the direction price is going to. That is what a trend is. Let me give you a live example. If you're going to, from your house to any landmark area, be it a ShopRite or a mall or a park in your area, from your house to that location is the trend direction. You are going front. So your trend direction, we can say, is bullish. Okay? You're going bullish to the landmark area. I hope you understand. If a car moves from point A to point B, we said it's moving in a trend. Now we don't know the direction of the trend. So point A to point B can be down. We'll not say it's a bearish trend, or point A to point B can be up. We'll not say it's a bullish trend. Do we understand the concept of trends that way? If we understand, please drop a yes in the chat box. If you don't understand, please drop a yes in the chat box. If you understand, please drop a yes in the chat box. Real quick, real quick. I'd like to get more response. I'd like to get more response. Brilliant, brilliant, very, very brilliant. Now, trend trading is a strategy that involves using technical indicators to identify the direction of market momentum. Okay? Trend trading is a strategy. Trend trading is a strategy that involves using technical indicators to identify. Downtrend is called bearish. Okay? Trend trading is a strategy that involves using technical indicators to identify the direction of market momentum. It is based on the idea that the markets have an element of predictability. So by analyzing historical trends and price movements, a trader will be able to forecast what could happen in the future. Once you can be able to analyze, see the trend with your eyes, you'll be able to understand what is likely to happen in the future in the markets. You have a full grasp or a whole grasp, a full concept of where price is likely to go to in the financial markets. You have a good understanding of how price should move. Once you understand trends, once you understand how to read a trend, and we said in a trend we have series of highs and lows. If it's an uptrend, we have higher highs and higher lows, like this right here, like this one going up. We have series of higher highs and higher lows, higher highs and higher lows. While this one going down, we have series of lower highs and lower lows. Basically, reversals. Okay, reversals typically refer to large price changes. They refer to large price changes where the trend changes direction. Large price changes where the trend changes direction. Large price changes where the trend changes direction. So let's say we're going to a landmark area as we discussed previously, from your house to point A. Then getting halfway from your house to point A, you now decided that point A was closed. You have to go to point B. That means you reverse, right? That reverse is like you're reversing your car, or if you're walking, you turn around. That reversal is called a trend change, a price change. You were going front before, you now decided that there's no road in the front, you now decided to turn back. That's a change in direction. Trend changes direction. Okay, so a large change in your perspective. You were going front, but now you couldn't go front anymore. You decided to go back because that is the only way around to where you're going. Small counter moves against the trend are called pullbacks or consolidation. And I'll show you today how to distinguish from pullbacks and reversal or consolidation or retracements from reversals. Okay, properly distinguishing between retracements and reversal can reduce the number of your losing trades. I will tell you the fact. It can reduce the number of your losing trades. If you understand the difference between retracements and reversals, you will end up not losing trades as much as before, because you understand this is not a reversal, this is a retracement. You shouldn't be capitalizing on it. So once you can properly distinguish between retracements and reversals, it can reduce the number of your losing trades and even set you up for some more winning trades. That's just the idea and the concept behind reversals and trends. Okay, a trend is what leads to a reversal, and a reversal is what leads to a trend. Let me show you a quick example on the charts. Let me load my MT4 and show you a quick example on the charts. Getting my MT4 loading. Getting my MT4 to load. Okay, about to share my screen right now. Now, permission to take away the profit cross strategy. Okay, or a minute, let me just check right there. I want to show a very, very quick example. Okay, yes, let's use ERUSD. Now, you all will agree with me that this was an uptrend, right? Do we all agree that this was an uptrend? Yes or no? Do we all agree that this was an uptrend? Yes or no? Real quick, let's drop our response in the chat box. Do we all agree that this was an uptrend? Yes or no? Brilliant. Okay. Now, understanding that this was an uptrend, do we all agree that this was a downtrend, or this is a downtrend? We all agree that this is a downtrend, right? Okay, great. Now, what do you notice from the uptrend and the downtrend? Okay, now let me tell you what basically you need to notice. We had a high and a low. Okay, then we had a higher high and a higher low. We had a higher high and a higher low. We had a higher high and a higher low. We had a higher high and a higher low. Then we had a higher high. We had a higher low, but we failed to create another higher high, right? Look at what happened. Trying to click on this. What happened? We had a reversal happening here from bullish scenario to bearish scenario, right? From bullish scenario to bearish scenario. Now, what caused this reversal? Market structure. The bullish market structure broke and shifted to a bearish market structure. Can you see it clearly now? Do we all see what happened? How we went from bullish to bearish? I'll be talking more on it in the slide that I'll be showing you guys. Now back to this. We can now see the difference between a trend and a reversal, how the U-turn happened. Okay, we can see how the U-turn happened to the downside. And also we can also see how the U-turn happened. Let me show you how the U-turn happened from the downside. See how the U-turn happened here. This is how the U-turn happened from bearish scenario to bullish scenario. Bearish to bullish. Bullish to bearish. Do you see it? Do you see how it happened? Do you see how it happened from bearish to bullish scenario? Do you see how it happened from bearish to bullish scenario? Bearish to bullish, bullish to bearish. Brilliant, brilliant. Now, let's go back to the slide. About trends and reversals. You can see we had an uptrend here. Reversal point, the top, the highest point. And basically, we had it here also. Let me show you right here. See where we had our reversal here. The same area. That's where we had our reversal. Reversal happens at tops and bottoms. Highest point in price and lowest point in price. That's where reversals happens. You can see what we had right here. Lowest point in price, reversal happened. Highest point in price, reversal happened. And you can see on the slide also, highest point, we had an uptrend. Highest point of the uptrend, reversal happened. And we had a downtrend. How does a reversal occur? Let's talk about this in detail. Probably, the easiest way to identify a trend reversal occurring is by analyzing the movement of the currency pair by eye. Okay, looking at the charts with your eyes. We notice a trend reversal is likely to occur once signs of exhaustion are noticed in price, and when price tends to consolidate and give off wicks as rejection, as this print certain pattern that we'll talk about next. Okay, I remember on Monday's class, someone asked, how does it distinguish a reversal from a retracement? And I made mention of rejections and wicks. I'm not sure if that person puts that into consideration, but I bluntly told the person the truth. Because for a reversal to occur, you have to see rejections and wick formation. While a retracement is just going to be slow movement against the direction of that financial instrument. Okay, now for now, let's go to the charts and see rejection and consolidation as they occurred and what happened previously. Okay, let's go to the charts right now. Let me share my charts. Let's see rejections and okay. Now this is a a consolidation and rejection. Wicks were everywhere right here. Okay, so this is a reversal point. Look at this one right here that I marked earlier. Consolidation and rejection, wicks. Then what happened immediately? A reversal occurred. Look at this, rejection, wicks everywhere, and consolidation. Then a reversal occurred. Let's go back and see more. Look at this one right here. A huge range. A huge range. Before we now had like everything happened in this area. See, it's even continued to happen into this area. Rejection and wicks everywhere before we now change direction. Consolidation and rejections everywhere before we now change direction. Right here, down below here. Rejection and wicks everywhere before we had a reversal. See, consolidation, rejections, and wicks everywhere before we had a reversal. So you can see basically that's all that happens in the market over and over and over again before we now get a reversal. Now, how to spot a reversal? How do you spot a reversal? How do you spot a reversal? But before I continue, are we all following? Let me send out a poll. Are we all following? Drop a yes or no in the chat box. Are we all following? Yes or no? Okay, I was told to come again. Are we all following? Do we understand the things I've said? If you don't understand, tell me. I'll go back because of you, okay? I'd go back to talk about it again because of you, okay? If you don't understand, signify. I'll go back and explain it over again because of you, okay? I just said to come again, okay? I will go back and explain. I'd like to get more response. I'd like to get more response. Are we following? Are we following? Is there something we don't understand? Should we go back to the next slide and talk about it in detail, right? Okay. I'd like to get more response. I'd like to get more response. I'd like to get more response. Are we all following? Yes or no? Okay. So I'll go back to how does a trend occurs. Okay. How does a trend reversal occurs? Now, I want us to listen closely. Okay. Probably the easiest of ways to identify a trend reversal occurring is to analyze the movement of a currency pair by eyes. Okay, not using any indicator, you not using your eyes, looking at the chart yourself and seeing this thing occur. That's how to identify a trend reversal. Okay, we notice a trend reversal is likely to occur once signs of exhaustion are noticed in price. Let me stop there. When I say exhaustion, I mean weakness in price. How do you identify weakness in price? Is by seeing wicks, W-I-C-K, wicks. The highs and the lows of price are called wicks, okay? Wicks rejecting of a certain area in the market. That's how you identify exhaustion. I'll go to the charts and show you again. I'm coming. We'll talk about that also, Cyril. Don't worry. Talk about that. When price tends to consolidate and give wicks off as rejection, when price tends to consolidate and give wicks off as rejection, it prints a pattern which is just the consolidation, then the breakout. And that's what we'll be talking about next. But for now, let's go and see how this rejection and consolidation occurs, which was where I brought us to this chart right here. Okay, to show us this is what do we have here? We can see wicks, consolidation, then wicks everywhere. Yeah, you can see how wicky this place is, if there's the word like that. Okay, how weak off these areas are. And look at what happened right next. We broke structure to the downside. We reversed the direction of the market. Look at this right here. There were wicks at this area also. Wicks everywhere at this area. Wicks everywhere. Consolidation. Then look at what happened. We reversed the direction of price. We stopped going from bearish and we start going to bullish. This is the most obvious one, which is see how the consolidation is much and how there are a lot of wicks in this area. And look at what happened. We stopped going up and we started going down. See it right there. Look at this also. Wicks everywhere here. Wicks everywhere here. Wicks everywhere here. We started going down. We consolidated, gave off a lot of wicks, and we changed the market direction. Look at this right here also. Rejections everywhere. Then we consolidated weeks also, and we started going up. Okay. Same thing right here also. Rejections, weeks, consolidation. We change direction immediately. Do we understand now? Do we now have a grasp, a concept, an idea of how reversals occurs? Yes or no? Please drop it in the chat box. Drop your response. I'd like to get a lot of response because a lot of people responded they didn't understand. Okay, so on to the next slide. Okay, sorry about that. I had audio difficulties. Now let's up into how to spot a trend reversal. Now, please, if you've not been paying attention, if you've not been taking notes, this is the right time to pick up a pen and paper or just screenshot your screen. Just screenshot your screen. Okay. How do you spot a trend reversal? You spot a trend reversal, number one, a break of market structure. What is market structure? Okay. Market structure is a word coined from two different words. Okay. Compound word come from two different words. This is market and structure. Market, price, okay, price in the financial markets or price in the financial space. Structure, the model in which price is using to move. Okay, now a break of market structure means when price breaks a certain model in which it is using to move. That's what a break of market structure is, and these are important levels, as it is an area that decides if price is going to go higher or lower if broken. Now let's go to the charts. I'll show you on the charts as we are going along, so I don't have to come back to it at the end. Okay, so looking at this chart, we said market structure have series of higher highs. In an uptrend, we have series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. In a downtrend, we have series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. Okay, now when we see last significant area of structure, all we are saying is the last lower high, the last lower low formed and the last higher low formed. Like for instance, now this is an uptrend and this was the last higher low formed. Okay, this right here was the last higher low formed. And we said if price breaks it, we have a change of market structure. And what happened? What happened thereafter? Price broke it, retraced back into it, then started going down. So this is what we call breaking market structure. Let me show you also down here. It's right down here. Okay, it's down below here. Breaking market structure. This was the last lower high. Look at what price did. Immediately price traded above it. This was the last lower high right there. Can you see that here? I paint in gray. Once price broke its direction changed and started going to the upside. So that is the first method or the first way to spot a trend reversal, a break of market structure. Okay, to the next one, a break of support or resistance area. These are important levels, that is the last line of defense for buyers and sellers. If it breaks, it's pretty much game over for either the bulls or bears in charge. A break of a long-term trend line also acts as a trend reversal. There are times when the market respects an important trend line, and if it breaks, it tends to lead to the trend is getting weak and huge tendencies of a change. Let's go and see that on the charts. We all know what support and resistance is, okay? Support and resistance are areas where we look for buys and areas we look for sell. So let's look at this area right here. I'd like us to go to a much more smaller chart where I can show the progress of support and resistance. Okay, so let's take a look at this. This shows that price was going up. Okay, this shows that price was going up, and this acted as an area of support. This acted as an area of support. Okay, this acted as an area of support, right? Support are areas where we look for buying opportunities. Look at this area right here. We saw buying opportunities here. Okay, once the support or resistance area breaks, it shows that trend direction change. Look at what happened, right? We broke it and we came back into it, and what? We went head on to the downside. Let me go and look for resistance areas that broke. Okay, trying to look for a very, very reliable resistance area. Okay, yes, this is one right here. This area acted as resistance, kept price lower basically. And look at what happened. Immediately we broke it, price changed direction and started going up. So you see, so basically that is it on when it breaks trend direction, support and resistance breaking trend direction. Now let me show you another one, which is trend line. Okay, now I have to reduce my chart so everybody can see it better. Look at this trend line I'm plotting right here. Can you see it? Trend line also acts as support and resistance. Okay, so support here, support here, support, support. When it broke, what happened? It started acting as resistance and price started going down. Let me show you another one also. Let me show you the one for a downtrend. I can't find one right there, but let's go to another chart. Let's go. Okay, I think there's one on the 4-hour time frame that I drew out here. Okay, this is not really a perfect trend line, but let me just I don't want to wipe that mark out. I remember I shared it with you guys. Okay, yep, this is one right here. This was GBP USD that I called. If anybody remembers, I said GBP USD will sell into this area. Just a quick one to show you guys how trading is easy. Okay, I said GBP USD will sell into from this area. I don't know if anybody remembers, right here into this red line down below here. We are still expecting price to go into the red line down below, sha. Soon it will. Okay, so let me show you from a downtrend to an uptrend. I'm trying to look for a uptrend to a downtrend. Sorry, a valid one to be precise. Okay, let's just use this one. Okay, so this is a trend line acting as support. And see, once it broke, price started coming down. This is a trend line acting as resistance. Once it broke, price started going up. So basically, that is how it works when it comes to the aspect of trend lines. That is how it works when it comes to the aspect of trend lines. Now, overextended markets. If the market seldomly trades in one straight line, it is overstretched. It usually corrects majorly after such extended move. Now, a very good example of overextended markets is the indices, the US 30, the NASDAQ, and all. You notice that recently they've been falling. The reason they've been falling is because of they are overextended. They've been overbought. Okay, they are supposed to have sold for a while now, but they haven't. So when they become overbought, it starts selling off, and when they become oversold, it starts buying from there. Okay, so it just means the market has been going in an uptrend for too long and needs to come down. And it basically means the market has been going in a downtrend for too long and basically needs to go up. That is what an overextended market is. And you can see it on the charts also. Let me quickly show you. It's even on GBP USD that we're checking right now. Let me show you. This is an overextended market. It sold for too long, and all of a sudden it just reversed, started going up. This is an overextended market. It's bought for too long and it started going down. So basically, this is how it happens. This is not an overextended market. Let's look for an overextended market, basically. Let's look for an overextended market. This is an overextended market, bought for too long, then sold off. So you can see how these things occur every single time in price. You can see how they occur every single time in price. So let's go to the next one on the list, parabolic move. Okay, now a parabolic move is if the market has been trending for a while and suddenly goes parabolic, it's a good sign that the top is near. Now, parabolic moves mostly happen on GBP pairs. GBP pairs. Now, the reason is because of GBP. I would not say GBP has a spirit of its own, but it has a method of moving. Okay, it has a method of moving. This is a parabolic trend. The market just kept going down. It didn't give you series of lower highs and lower lows. This is a parabolic move. It just went down. All of a sudden, it just went up also. So you see, this is a parabolic move. Let me show you. I think it happened on ERUSD also. I think it happened on ERUSD also. This is a parabolic move from the upside to the downside, to the downside to the upside. A parabolic move happened to the upside. Didn't give you any lower highs to hop into the trade. It just reversed that going down. Didn't give you any lower highs to hop into the trade. Didn't give you any higher low to hop into the trade. That's how a parabolic move happens in the market. That's how a parabolic move happens in the market. It's not difficult at all to spot. You just need to know that when that candles, or whenever your candle has printed consistently or consecutively, like 6 times, 5 times, you should know that's a parabolic move. You should expect a reversal that will not going to give you any sign at all. Okay, so basically that is how to spot a reversal. So someone asked the question, what time frame is reversals reliable? I'll show you right now from my key takeaways. Now, going to the last thing on the slide, key takeaways. Okay, pay good attention to this also. When the market transitions from bullish to bearish, you see a bearish reversal pattern. When the market transitions from bearish to bullish, you see a bullish reversal pattern. Bearish reversal patterns just means the reversal is going to occur at the top. Bullish reversal patterns means the reversal is going to occur below. That means we are moving from bear to bull for bullish, reversing below. While from bull to bear, it means the reversal will happen on top. That's basically what it means. The most common bearish reversal patterns are double tops, triple tops, and head and shoulder. Okay, the most common bearish reversal pattern, that means you see double tops forming, triple tops forming, and head and shoulder patterns forming. We've talked about chart patterns previously in our old webinars. You can go and check the YouTube channel, it's there. Their bullish reversal counterparts are just the reverse of double tops, triple tops, and head and shoulder. Okay, we have the double bottoms, triple bottom, and the inverted or the inverse head and shoulders. The reversal patterns are considered complete when price breaks the neckline. That means once price breaks support or resistance area, the reversal has happened. Okay, you need to wait for price to go in that direction, then you start taking trades in that direction. You always wait for support and resistance to break when you're looking for reversals, so you can enter the trade precisely and not too early. Because when you enter too early, it might take you out of your trade by hitting your stop loss. The next thing is bilateral patterns are when price converge at the point. They can either break out in either direction. When price is consolidating, this is when bilateral patterns form, because they can either break out at any point. Okay, so it means it's either continue to move in the direction or reverse the trend. And they can be symmetrical patterns, ascending or descending patterns, where you need to be cautious not to look for reversals in the area. Even if you want to look for reversals in the area, make sure there is higher time frame support, where we are now going to Cyril. Your question will be answered here. Higher time frame reversal patterns. Higher time frame reversal patterns. That is where your reversal is most reliable. They will dominate every lower time frame reversal pattern. Try to trade in line. It's not even try. Always trade in line with the higher time frame bias, with a higher time frame pattern, because that is how you can make the most money from the financial markets. See, when we talked about trend reversal, it's important to know how to spot and trade a trend. You must understand how to spot and trade a trend before you even want to start trading reversals. But it is equally important to know how to spot a trend reversal also, because this is crucial. You don't want to be caught up in a trend move once it has ended, and you want to be able to get in on a new trend also. Okay, so these are the key takeaways in everything we're talking about. Let's go to my conclusion. Okay, now I know somebody might ask a question: is there any method that we can use to spot trend reversal except from using our eyes? Yes, there are a lot of methods, but the truth is there is no method that can show you how to identify trend reversals with 100% accuracy. There is no method at all. Instead, what you can do is read price action and identify the possible area where the market could reverse. The more confluence factor they are, the greater the likelihood of a trend reversal. we've come to the end of today's webinar. Thank you very, very much